All right, thank you very much, Dan, and welcome everybody here to the webinar. By way of introduction, my name is Jim Kenney, and I am the content provider for Option Professor. And Option Professor does have 7 option learning DVDs, which I'll talk about at the end, that go for about 45 minutes to an hour, that go through a wide myriad of information on the options, starting out with beginners, introduction to options, and then of course going into the different strategies on each DVD. So for the selling or writing strategies, we have a DVD going over covered call writing and put writing, et cetera, et cetera. Then we have one that goes over that was put together for hedging, protecting against market declines. And then of course we go over different strategies for spreads, credit and debit, and then of course rolling and repairing positions. And then we go over directional, two-sided trades like straddles and strangles, some different technical indicators. So there is a whole lot of information on those DVDs, and I'll talk about that later in the broadcast. Today's quite a day for those of you are watching the markets, because we've had the volatility measurement go up as over 25% today, which is a pretty darn big move, particularly since it jumped from as low as about 11 or so, or 11 or 12, just about 3 days ago. So this has definitely been a spike up in volatility, which also translates into a spike up in some of the nearby options, in particular on the S&P or some of the stock indexes, because obviously when the VIX jumps up like this, the put premiums can expand dramatically, and of course they're shrinking the call premiums, particularly in the nearby months. Before we get started, it is important to remember that option trading involves risk and is not right for everyone. It's also to remember that past performance is not indicative of future results. Also, the things that I'll talk about today is not going to be advice, but it will be a sincere opinion. There's no guarantees, warranties on anything that we're saying, implied or given. And of course, with regards to trading, you should go to your brokerage firm and your broker and get all the risk disclosures, understand them, sign off on them before you consider any option trading. And of course, they will be responsible as well as yourself if any option trading may be suitable for you. Also, many of the comments that I'll make today obviously are opinion, and opinions can vary dramatically, and maybe some of the things we discuss have already been factored into the prices. So don't forget that. Some things we talk negatively or positively about may have already been factored into the prices. We don't know that. Second, and finally, options do not go one for one with the market. In other words, they do not move one for one with the market until they are trading at intrinsic value, which generally will be if they're close to expiration and they're in the money, meaning they have gone through the strike price, or if they are deep in the money, meaning they've gone way through the strike price. Then of course they also may be working on a one-to-one basis. But when all the time or volatility value has been taken out and they are trading at intrinsic value is when they trade one for one with the market. Okay, just wanted to make sure we cleared that up and make sure everybody's aware of that before we proceed. With regards to my background, again, I'm a graduate of Boston College, and I attended the UCLA Executive Management Program many, many years ago. I also have been trained at the Options Institute in Chicago at the CBOE, also a long time ago. And in my career, I've been fortunate enough to work at some of the largest brokerage firms in the world who had in-house training programs. So I was able to obviously get extremely educated over the years through hanging around with people who knew a lot about options, going to these training situations, and so I've been fortunate enough to benefit from that. I've been conducting seminars throughout the nation for a long time, over 25 years. And so some of you may have even been to some of the seminars. We used to obviously have them in hotels, and then people would go in theater-style seating with a paper flip chart and obviously attend. The good news there is we are very close physically during those, and so during breaks, etc., we can cover a lot of specific questions. At the end of the broadcast, I will have a phone number you can call, and also a website you can click on. If you have questions that we don't cover here today, I'd be more than happy to to work with you on that. So, basically today what I'm going to go over is a wide variety of strategies which are available for explanation on the DVDs, and also go over some of the things that are going on in the market, particularly in a day where we are obviously very volatile, and of course the price of crude oil has been very, very bouncy. So a lot of people are getting taken back by this volatility, but in some respects it's not that far out of expectation if you're looking at the markets. With regards to in the news today, before we get into strategy, just wanted to make sure everyone had a pretty good hold on some of the things that might be affecting the market. There is some speculation that the Fed might be doing something with the interest rates here, and maybe starting to announce what their plans are, and maybe removing some language that used to be in the statement, like considerable length of time before rates change, that kind of thing. And then, of course, some of the earnings will be coming out in mid-January, but some of the early ones, like AutoZone, Costco, and had pretty good upbeat earnings, but the majority of the big guys will not be coming out till around the middle of January. What I'd like to do here is get involved a little bit in some of the strategies, and again, I don't have everything outlined, so if you have a pen and paper handy, walk through some of the math with me. It might be helpful to you. With regards to covered call writing, okay? Covered call writing is a strategy where you're trying to create cash flow and income, and you're also trying to hedge yourself a little bit against the market decline. Collar strategy, which is one where you're trying to protect your values, combines the covered call writing with the put buying, and they work in concert. And then another form of protection against market declines is also called the put hedge. But let's go over one at a time here. Covered call writing, okay? And again, we go over all this in great detail, 45 minutes to an hour on the DVDs. I'm only going to briefly cover it now. And this is not going to be, anything I talk today will not be exhaustive on the subject matter by any means. Covered call writing, though, you own the stock, right? And you are going to sell a call. What does that mean, sell a call? Well, when you sell a call, you're going to be picking a striking price, and you're going to sell the call, which means you're going to be the writer. And therefore, the writer or the seller of anything in life gets money, right? So you get money paid to you by selling the call, and the reason you got paid is you have a responsibility. And what your responsibility is to deliver or sell your stock at the striking price until they expire, should the buyer want to exercise it or take it away from you. So basically what you're trying to do here is you need to start out by saying, okay, I'd like to create some cash flow and income. First thing that I would be looking at is, what do the premiums look like? I mean, I've seen people tell me they're doing covered call writing for 10 cents, 15 cents, 20 cents. The first thing I say to myself is, if you're going to be willing to sell your stock, which is what you're doing when you sell a call, if you're going to be willing to sell a stock and you're only asking for a quarter of a point premium, you are going to be receiving a very small amount of money. And you're giving up all rights on your stock and all dividends that you might receive if it's called away for such a very small amount of money. So logically, you'd say to yourself, if you're that neutral to negative on the stock, you might consider just selling the darn thing. Because if you're willing to get rid of all those values for just 25 cents a share or 10 cents a share or some of these ridiculously low premiums, my view would be is you obviously don't think very much of that stock. You might want to put your money elsewhere. That's just my opinion. So the first thing you do with the covered call writing is you want to get paid, right? You want to get paid. And when the VIX jumps up like today, up to 1838 or whatever it's going to end up at, anywhere between 18, 19 or higher, that's considered a fairly high VIX. And so the bottom line is it can spike up to 30, 40, or wherever it wants to go. But, when the VIX jumps up, generally the premiums are expanding. So first thing is how much am I going to get paid on these things? What are the premiums going for? The next thing is, and this is not in sequential order, you could do it in any order you want. The next thing is, how am I going to select what striking price I might want to use? And obviously that's going to be factored, in my view, in my opinion, on where you think the underlying market's going. So if a stock was going for $30 a share and you had three strike prices in front of you, the 35 call, the 30 call, and the 25 call, Stock's trading at 30. And let's just say for arguments or an example, theoretical example, again, limitations on it, but just ballpark idea. Let's say the 35 call was going for $2. Obviously, it wouldn't include spreads or commissions or anything, so we're just talking hypothetical, theoretical, general number. Say it was going for $2 at 35, or the 30 calls were going for 4, or say the 25 calls were going for 7. Okay, you got 3 strikes, you got 3 premiums there, right? Okay, if you think the $30 stock is going moderately higher, the most reasonable thing you might want to do is sell the 35 call, slightly out of the money. Why is that? Because when you sell the 35 call against the $30 stock, you're giving yourself a $5 potential gain between 30 and 35, plus the premium, which is 2. So you could come away with 7, which is better than 20% on $30, which is not a bad deal. Okay? Now, that's if you think it's going moderately higher. If you think the market is going to be sideways, then you're going to gravitate more to the at-the-money option because you don't think it's going plus or minus that much anyway. And so if you took $4 in on a $30 stock, that's what, 10-15% on the $30. And so that's not such a bad deal to collect that cash, and if you can get to keep your stock at the same time. So that would be something to consider in a neutral market. Now, if you think the market's going to take a dip like it's doing now, you might have been better off to sell the 25 call on a $30 stock because you're going to take in on that one we mentioned as an example, $7, right? So if you took in $7 on a $30 call and the stock's at 30, if it dropped down to 23, the $7 you received, okay, minus the $30 it was at when you did the deal, brings your protection down to about 23. Again, this doesn't include a lot of factors, so again, don't hold it to the penny here. I'm giving you a general idea, and this is not on any particular stock either. This is just a general theoretical idea. So if you sold a $25 call in the money, stock's at 30, you got $7, it goes back to 23. It expires, right? We're talking about an expiration date. On expiration date, if it's down at 23, you're going to keep the $7 on the $25 call. You're going to still own the stock, but rather than losing $7, you're going to be flat. Okay, so that's why people would sell the deeper in the money call if they thought it was going to go in the tanker. Okay, so again, there is no perfect science to any of this, and then of course, you've got to be careful on what your tax situation is, what your cost basis on it. So there's many factors. I'm not trying to make everything look like vanilla and chocolate ice cream. Sometimes there's other factors to consider in there, so you got to be aware of that. That's why you got to talk to somebody who has an idea of what the heck you're talking about, who also can talk about your particular situation, who can go over the factors that might come into play for you. Okay, so a couple of other things on covered call writing. Again, how much are you going to get paid for this thing? What strike price you're going to choose, right? Another thing might be, if it starts going in the money, when do I get exercised? A lot of people doing covered call writing, they can't answer any of these questions. I know, I do these seminars, 25, 30 years? They raise it, oh, I know covered call writing. Yeah, you know it? Well, how does this work? How does that work? And then they get a faraway look in their eye. There's a lot more to a lot of these strategies that are being touted around town, and having been in the game for 30 years or better, believe me, I've seen them come and go. So the point being is you want to understand the use and the risk of these strategies, which basically is what I can provide. Understanding the use and the risk of the tactic, and then implementing them, obviously, is the guy who's doing the trading. Talking about when you get exercised. A lot of people, oh, I'll never get exercised, it's out of the money. Well, listen, buddy, there's another factor, and there's many factors, but there's another factor called dividends. And to give you an idea, if your option is $1 out of the money, in other words, the stock might be trading at 29 and you've sold the $30 call, right? You're out of the money, so you figure you're okay, right? Not going to get called away. But you forget that dividend date is coming up, and bottom line is it pays a $2 dividend. Well, you might find somebody who wants to grab that stock and capture that $2 dividend and doesn't mind losing $1 on his strike price versus the current market price. So obviously if he takes a hit of $1 between 30 and 29, but he captures $2 as far as your dividend is concerned, he's still going to be net ahead. You're going to be walking down Main Street going, what happened? So you got to understand what your dividend dates are going to be when you're doing covered call writing, because that's another factor that's going to come into play at some time, particularly for some of these stocks that pay decent dividends, which are many of them now, right? Okay, why do they pay dividends? Because they want you to invest in their stock. Why do they want you to invest in their stock? So they have the money. What are they competing with? They're competing with zero money market. So obviously any dividend looks pretty good when money market pays zero, right? That may not last forever, so that's another thing you got to keep in mind. But right now and for the last 4 years, that's been the game. Turning towards what do you do if it goes up or down? Well, there's certain adjustments you can consider. When the market goes through your strike and you say, hey, listen, I put a lid on this thing and I think this thing is taking off like a bat out of you-know-where, I think I want to take my ceiling off and raise my ceiling. So what you might consider there is rolling up the position. For instance, stocks at 30, you sold the 32 calls. Excuse me, the 35 calls. Stocks at 30, you sold the out of the money 35s. You got paid $2. Stock goes up to 35, now it's trading 36. And all of a sudden you say, you know what, I think I might want to raise this strike. So you see that the one you have to buy back, as an example, you sold for 2 and you got to buy it back for 4. Okay, so you buy it back at 4, you're going to take a $2 hit. But the stock is up in the 35, 37 area now, so you've seen an appreciation of the underlying stock of $5 or $7. So you have actually made some money net based on where the mark to the market is, despite the fact you lost a couple of bucks on the call. Now what you might want to do is try to recover that $2 on the call by rolling up, and let's just use the number 40. And so you say the $40 call is trading for 2. So you buy back the 35 for 4, you take a $2 hit, and then you sell the 40s for 2. To make up that $2 you lost on the 35. Now your window of opportunity does not stop at 35, but it is now up at 40. So your strike has given you $5 more of upside potential. Don't forget, though, that changes the original risk from where you started. So that's something to consider as well. Because if you're wrong and it goes back down, that paper gain that you had on the underlying security is also going to go bye-bye. So again, if it was just the easiest game in the world and everything was on a string and a trained seal, obviously it would be a lot easier. Lots of factors can hit these things. That's why you got to understand the use and the risk of every move you make and every strategy you consider. That's my feeling. And to be honest with you, in my view, there's a lot of people running around with half-baked ideas. 10 cents of knowledge and $100 worth of opinion, and that is obviously an imbalance, and that's going to be problematic at some point in time. Because this one guy in the movie said, brains will take you so far, and luck always runs out, right? So the bottom line is don't ever forget that, and keep that in mind as you're doing all your strategies. And always think about what the other guy, you're doing one side of the trade, well, there's another guy on the other side of the trade, and try to consider who's getting the better deal here. Who seems to be getting the better deal? If a stock used to be, $384, $390, and it jumps up post-split to $840, that's a pretty darn big run. And I know there's probably going to be good news on that company, right? But do you think some of that good news might have been used up during that run? And if there's any moderate news that comes out, do you think that, an order imbalance of people trying to get out of something where the buyers have dried up is going to be problematic? Well, just look at oil and it'll tell you exactly what happens when something has run up and then everyone tries to get out and there's no liquidity. But throughout history, liquidity has always been a culprit, right? And going back to 1987 for you older guys, you must know that the leveraged buyouts that were created during the Reagan administration at some point had no valuations that made sense, and there was no liquidity. So if everybody wants to sell something and there's no buyers, the market makers drop the bid very, very fast. Same thing happened in 2008, 2000 even with the dot-coms, right? No earnings. Everybody wakes up one day and goes, these guys are never going to get earnings. Let me go get out of these things. Well, you've got massive selling coming into a no-buyer environment, and you saw what happened in 2000. 2008, you had another good example of border imbalances. You had all these people buying homes with not a pot to pee in, no money down. They got 10 homes, right? Now, the loan to value goes negative. Who the heck wants to buy those mortgages? on negative equity plus guys who shouldn't have got the loans in the first place. So you got a liquidity crisis, and you know what happened in 2008. And looking towards the next 2 years, something to keep in mind is who's going to buy all this debt that they've created if people want to get out? In other words, how much debt do you think corporations, municipalities, governments around the world have created? And look at those stinky yields that they give. Well, if people wanted to repatriate money or get out of these debt instruments, some of these bond funds have 64, 80 million shares outstanding. And you know how many shares per day they trade? Some of them trade as little as 300,000 shares a day. So if 10% of an 80 million share outstanding fund wanted to get out, that'd be 8 million shares trying to come out. And the thing only trades 300,000 a day. Do you understand what kind of problem that occurs? So, you know, look for where order imbalances could occur, and it might be very helpful to your option trading as well. With regards to getting back to the point of covered call writing, why do people do it? They want to get the cash flow. Do you get something for nothing in this world? Absolutely not. You sell calls, you're giving up all rights to your stock at the strike price plus the premium. Can you buy it back at any point? As long as it's not fast market conditions, generally speaking, yes. Plus or minus what you sold it for. Now, if it goes up, we talked about rolling up the position. What about if it goes down? Well, if it goes down, direct opposite. You could possibly sell a lower strike. Meaning, say you sold a $30 call for $4, and the stock starts dropping to 27. You only got hedged down to 26, right? 30 minus the 4, 26. So you might say, you know what? This thing looks like it might really drop. Let me look at the 25 calls or the 20 calls. I might want to get more premium in my account to protect my principal. So you start looking at the lower strike prices to roll it down. You know, these are alternatives to consider. Are they right for every trade? Absolutely not. Could they be right for you? Who knows? Bottom line is that's what you have to decide. But you have to understand the concept of moving the options around. You've got to understand the concept of how to put them on, when to put them on, when the odds might be on your side, when they might not be on your sides. And then you got to live with your decisions. But without base knowledge and understanding on how the process works, I think you're playing with one arm behind your back, and that's going to be a fight you're going to lose, right? So keep that in mind when you're looking at some of these things. The covered call writing obviously has a place for some people. When I started, the reasonable thing to do with covered call writing was to try to double your dividend income. Nowadays, it's used for whatever it's used for. But the original concept that I heard covered call writing to be used for is to double your dividend income. So if you're making 3% and you moved it to 6%, hallelujah, you did a great job. Again, there's an opportunity risk. If it goes above your strike, you have capped your gain at that level. So if you think a stock's going from 30 to 60, and you have the choice of selling a $35 call, you're not going to take that choice because it is way, way lower than where you think the stock is going. So again, that's what using an appropriate strategy for an appropriate circumstance is all about. Turning towards the other situation we were going to talk about, which is the area of hedging. Okay, we talked about the covered call right? Now I'm going to talk about the put hedge. Why do people buy puts on their stock? Because they're trying to protect themselves against an adverse event. Why do you buy car insurance? Why do you buy, we have to, but want to buy fire insurance? Because you have to. Health insurance, because you might get sick, right? You are going to buy insurance against an adverse event. So, say you have a stock and you bought it at $50 and it goes to 80. Now you're $30 to the good, right? You bought something at $50. Say you bought 1,000 shares. You put 50 grand in. Again, that's a theoretical talk, hypothetical talk, not a real stock, not no spreads, commissions, or anything else. The other realistic factors. We're just talking general. You got 1,000 shares at 50 grand. $50. That's 50 grand. Stock jumps up to 80. You're feeling great, right? But you've been to the rodeo more than 2 days, right? And you know that sometimes you get thrown off the horse. So this horse is riding your way, and now might be the time to protect yourself against adverse moves. So you are now looking at a $30 gain, and you are going to take a look at the $75 puts, and say you're going to go 6 months out. Don't forget about options. time decay is most rapid in the last 30 to 90 days, obviously using common sense or the Black-Scholes model or anything else you want to use. Why? Because when options are starting to mature, the people who own them are freaking out a little bit that they are coming to maturity or expiration, and so that if they're out of the money, they're going to start getting whacked pretty hard because these people know they're coming due, using common sense as your guide. So if you're writing calls, generally 90 days and in is what people do. I hear people selling 2-year options. God bless you. I guess there's some value to that, leaps or whatever. But, be careful about how much you sell unless you're doing a certain type of strategy. But anyway, so if you buy puts, you would like to buy some time. Why would you like to buy some time? Because you're the buyer, and you don't want the darn thing to go to zero unless you're hedging against an event. If an event is going to be nervous, making you nervous in the next 30 to 60 days, you might not buy a 9-month option, right? But 9 months on a long option generally has been the time where the time decay doesn't immediately get hit as much as the nearbys, generally. And of course, there's opinions that vary on that. So you buy a longer term put at 75 bucks, and let's say you pay $5. So that's $500 each one. And if you buy 10 of them to hedge 1,000 shares, you're going to put up $5 grand. If you buy 10 puts on this particular example at 75, you have the right, but not the obligation, to sell 1,000 shares at 75 bucks. Your stock's trading 80, so you're $5 out of the money. What's going to happen after you buy this put? Many things can happen. Let's say between now and expiration, it stays at $80 to $90 a share. The expiration comes on your puts, so it's expired, 3rd Friday of the month for which they're written. And now your put has gone to zero, you lost $5 grand. But you still own the stock, and if it's at 90, your paper gain on that is $40 a share or 40 grand. Not perfect, but you're still ahead. Let's say during the period you own the put, it trades between 80 and 85, maybe going to 78 a couple of times, basically sideways. Never got to 75, time ran out on your option. Again, you lose your insurance because the adverse event you were insuring never occurred. So you lose the $5 grand, but again, you still own the stock. And door number 3, and there's many doors out there, door number 3 is that the market goes in the tank, and it goes back to 50 bucks. Now, you would have lost 30 grand worth of paper gain there because 80 back to 50 is 30 grand off the table. But you bought the 75 puts in this example. You back out the $5 a share you paid for the put, so now you bring it down to 70 grand. But you still hedged 20 out of the 30 grand you were up when you put the trade on. And that's got to feel better than the people who are scrambling for their equity when the thing goes in the toilet. So that's basically an idea, and we go over put hedges on the DVDs for an hour, but that gives you a basic idea of why people would buy married puts. Why do they call them married? Because they are married to the position you have on. You're not just buying them on a lark. Now, with regards to buying puts, a lot of people don't like to do it, especially on things that are going well. Why? Because they've already got enough premiums going to the insurance companies that they never see again, right? You buy car insurance, you pay your premium. Bye-bye insurance if nobody hits you. You got the health insurance, God bless you, everything's good with your health, and that's great. Next thing is you have got fire insurance in the house, nobody smokes, so those premiums are going bye-bye as well. So the bottom line is people don't like to buy insurance or puts because they've seen too many of those type of, shall we say, hedges go bye-bye. So there's another strategy people consider where somebody else gives you the cash flow, and you take the cash flow and you buy your puts with it. And that's basically the mechanics of the collar. What you're doing there is you own the stock, let's say at 50 bucks, and it goes to 80. So now you got a gain, right? You're trying to protect that gain. So here you go out and you sell a call at 85, a little bit out of the money because the stock's had a big jump, but you think it might go a little higher. If you think it's going way higher, you wouldn't do this. Okay, that's why I'm trying to tell you. Understand the use and the risk of the tactic, and then when you apply it, try to apply it to appropriate circumstance. So again, what you've got there is you're selling the call at 85 bucks, and let's say you're getting $6 a share. The market's been going nuts, so the volatility is big on the calls. You're getting a little bit more on the calls than you got on the puts. So again, you're getting $6 in this example, theoretical example. So you get $6 on the 85 call, stock's trading at 80. You got the ability to make up to what? 85, which is $5, plus the 6, which gives you an $11 potential, right? All right, but you're going to take $5 out of that 6 they paid you, and you're going to buy your insurance with the 75 puts that are trading at 5 in this example. So now what do you got? Stock started at 50, jumped up to 80. That's $30 to the good. Now you've sold the 85 calls, and you've taken 5 out of the $6, and you bought your 75 puts. You've created the collar. Now you got an upside ceiling of what? You can go from 80, where it's at when you do the deal, to 85, plus the dollar you didn't spend. So you can make another $6, which is like another 15% on the stock, right? Ballpark figure? Okay. That's on the upside. That's your cap. On the downside, you got the right to sell at 75, plus the dollar you didn't spend is 76. So you've got 26 grand of the 30 grand hedged. And if it doesn't do anything and it goes sideways, Peter paid Paul, so you basically look to collar it again. If you feel like it, if you think it's appropriate. If you, your advisor, whoever the heck you're dealing with, you know, your guru, whoever you're trading through, you know, if they believe what you're doing that's the tactic you want to elect to use. But every tactic has an up and a downside. For instance, the collar. Okay, if I cap my gain at 86, obviously if it goes to 96 or 106 and I don't do anything, there's an opportunity risk beyond 86, right? Okay, on the downside, it's at 80. But my hedge wouldn't kick in till 76, so there's $4 this year I'm going to get tagged on if it goes the other way. So there's no perfect world out there, and those who try to look for it come home very disappointed and disillusioned. But just understand the tactics, understand the appropriateness of the circumstances and the tactic, realize what the tactic brings and doesn't bring to the table, realize what you're getting, what you're giving up, and then whatever tactic you choose, you live by the sword and you die by the sword. Right? But if you don't understand all the alternatives, if you don't understand how that could help you, obviously on a day like today, you know what? You don't think the hedges kind of helped some people out there? I mean, you know, look 6 months ago. You think the people in all the oil shares and all the oil stuff, if they would have done some hedging up there when oil was trading 100, 107, they wouldn't be happier today as they go into Christmas time with all these losses? Obviously. But, you know, if you're trading on your own through this guy or that guy, or, you know, self-directed here and self-directed there, that's all great. But you're the quarterback. And when you're the quarterback, you got to know the plays. If you don't know the plays, you start looking like one of those quarterbacks who, you know, people want out of the game, right? So bottom line is, you know, what I've tried to do on the DVDs is take my experience, my knowledge, my ability to give you a balanced presentation and honest insight into how these tactics work, have you learn them so when you go into any tactic, you understand the use, you understand the risk, you might understand what different alternatives you have as the market bounces around. You know, just be a more knowledgeable guy. That's the main thing. You know, because nobody knows where the markets are going for sure, right? I mean, you know, everybody's got an opinion, and, you know, that does not make it fact, right? Because they say so doesn't mean it's so, right? So, again, working with an unknown called the future, you try to create strategies where many of the potential outcomes that you believe could happen favor you. And that, I think, is very important. Whatever you, in other words, if you buy a stock at $250 an ounce, a share, and it used to be 100, I mean, you know, the only outcome that's going to favor you is more up. A sideways or pullback or drop sharply down is going to be negative to you. So that's why, you know, when you look at anything, try to realize who's on the other side of the trade, you know, and what is their motivations, and, you know, basically, you know, think about, you know, of the outcomes that could happen, how many of them are favorable to me and how many are not, and then realize from there what you think's going on. What I'd like to do now is go over, if I could, a couple of different charts, okay? And for those of you who wanted to get an idea of where the markets might be closing here as we come into the 1 o'clock hour, try to give you a couple of prices here real quick. We got the Dow Jones Industrials here, and they are going home down 274 points. That's 1.5% lower than they were yesterday. I guess that hedging idea wouldn't have come in so bad in the last little drop here, huh? Again, the major trend of the market, as far as I can see, the long-term major trend remains up. But one thing I did notice is the transportation average.
I hate to interrupt.
Going into,
but we're getting some questions. You're talking about charts, and people are not able to see your charts. So
okay. No, I'll get to the charts. I was just giving the people a little rundown because the market just closed, and maybe they'd like to see how things went home. So
yeah,
I'll get the charts in one.
That sounds great. I just wanted to remind you to drag them over to that screen if you want to show. Thank you.
Okay, hold on. Yeah, good idea.
Sorry for the interruption.
No big deal. There's a chart to look at, and certainly going to be changing today. So let me give you another little rundown here. So the S&P is at 2025. Again, these are I'm going to give you a couple of opinions here. Again, there's no assurance that what I'm saying is accurate, but I will tell you something here is that the transportation average, which tracks the airlines, the trucking companies, and the railroads, they're down to 88.59. The lowest they hit yesterday, I believe, was around 88.40. That's a 5% drop approximately from the high, 52-week high of 93.10. So if the S&P was going to follow in concert, a 5% drop from the high of 2079 would take us to as low as 1975. So that is something to keep in mind if these things are going to run in concert, which there's no assurance that they are. But it would be something to keep an eye on. And obviously we don't know what the future holds, so that would be a guess on if they were going to remain solid, where the S&P, if weakness continued, could be bouncing around toward. At any rate, there's your chart on the S&P. Okay, and I showed it to my sixth grader last night, and I said, you think the prices are low or high there, Johnny? His name's not Johnny, but we'll call him Johnny. And he said he thought they looked high, So anyway, the market is pretty high, and that's why learning how those hedging tactics work is not exactly the worst thing to look into. In some cases, it's a little late, like on the energy shares, but obviously on some cases, it may not be late. At any rate, a couple of things here. 2079 has been the high, and I have a long-term moving average that I look at that comes in at around 1800 to 1850 ballpark area. So we are back into the overbought condition, not unlike we were in October when the market was at 2020 and the long-term average I looked at was around 1800. We came down and tested the average and then came back up. Are we going to come all the way down to the average again? I don't know. But there's certainly some downward momentum right this second, and certainly, it is a little bit on the defensive right now because it got into what they call an overbought condition, in my opinion, technically. And when you get into an overbought condition technically and any moderate news comes out, sellers could come in, and you can just imagine if you follow the volume figures for the last 5 years, volume up at these areas has not been anything to write home about. So you've got higher prices on a historical basis. We don't know if these are higher or we're going up another 20%. I don't know that. I do know just what I do know, and this is obviously past performance, no assurance of future results, but it is telling me what has happened. And what has happened is a major league advance, no doubt. And then, again, with the volume getting skinnier as we've gotten higher, again, if you do get some selling to come in, it is hard possibly because of order imbalances, not unlike you saw in the energy markets, that the order imbalances could cause a sharper drop, which is something I guess we're having a little bit of today. At any rate, you can see, by any measure, the overall trend has been overall up here ever since we turned up pretty much in 2010. Basically, higher highs, higher lows, and there you go. In fact, that move in October was, in the last 24 months, even 36 months, one of the bigger moves you've seen in a very long time since that late 2011 drop. Again, very short-lived, though, between October 30th or October 20th or whenever that happened, until just recently. This thing not only recovered, it made a brand new high. So I don't know, I haven't watched the RSI, but was there a divergence on the new high versus the RSI not making a new high? That might be another thing to keep an eye on for those of you who watch the relative strength index and what they call a diversity, between the high price and the RSI, something to consider there. At any rate, your transports were down 120, and your VIX, again, was up in the 18 area, so that's the story there. Some strategies that people use during a rising market is put selling. And why do they do that? Because when the markets are rising, the puts will go to zero if the market does not reach their strike and the time runs out. And people believe that sometimes the shorter term options, maybe a month or 2 or 3 out, if they're far enough out of the money, can create a situation where they can create cash flow on their margin deposit. But again, the risk there is if you get caught into a October drop, you may hit margin calls, you may have to buy back that option much higher than you sold it, and therefore you could wipe out the gains you might have received for the last 2 years if you don't watch yourself. Or basically respect the fact that the market can have a correction. I know a lot of people are selling these weekly options, and obviously they get away with it for a while, but can you imagine what happened to them during that drop in October? I bet you they got whacked pretty hard. How hard is going to be how quickly the guy buys it back and get the heck out. But if you sat there like Buddha and the thing drops like that, believe me, and the VIX jumps to 30, those options are going to scream on you. And if you have to buy something back for 40 that you sold for 4, that's not going to help. That's going to be a problem. And it can be a problem that's very difficult to recover from, because if your writing strategy brings in premium, don't forget, you're only bringing in limited cash flows, correct? All right, so you're bringing in limited cash flows. That means that's the revenue side of your business. Now, you can't afford to lose 40 bucks on an option and then what? Bring in 3 bucks for how many months in a row you'd have to be right just to get back to sea level. That's why you see a lot of these managed accounts, if they get whacked hard, they close down the fund, because the only way these guys are going to get their percentage of profit is to get their equity back above sea level. And if they're down, 30, 40%, they'd have to be trading your account for 5 years for free maybe just to get back to sea level, and that's just not going to happen. So again, that's not the case in all cases, but I'm sure that is a case in some cases. At any rate, again, the moving averages are something I keep an eye on. The 200-day moving average on the S&P comes in, let's see, as of yesterday, it came in at 1943 on the S&P. The NASDAQ comes in at 43.88. The NASDAQ today probably got whacked pretty hard as well. Let's take a look real quick. And that came in down 1.75%, and that was down to 46.84. So my point is that when we're at 4,800 on the NASDAQ, where we were, and the moving averages are down at 4,300 and change, that is what they call a technical overbought condition based on the moving average. Okay, it doesn't have to be, doesn't have to pull back, but there is sometimes a probability that people might say it could pull back, and the odds are increasing the further away it gets, not decreasing. Some would say that. These opinions go all over the place, so don't, again, that's just what I'm saying. With regards to your transportation average, your 200-day average is at 81.83. We're trading in the 8800s. Lots of room between the 200-day and where we are now in transports. And same thing on the Dow. The 200-day average is at 16,834. So at this point in time, one might say that we're in an overbought condition and they're taking the froth out. That's what one might say. Others might say we peaked and we're going to roll over and the beginning of the more serious correction has begun. I don't think there's enough evidence to make that comment, but of course anything could happen. Again, as I was asserting to earlier in the broadcast, these presidencies, when they sometimes don't end so well. 79 was the end of Carter. Had a lot of problems over there at that time. We had to get interest rates up to 16% on the long bond, 22% money market. For those of you who are older than a millennial, if you read your history, there's a guy named Paul Volcker was the Fed chairman, and he was raising rates like a crazy man. Boom, way up there to bring inflation back in. Now there's deflationary fears, so interest rates are at 0, and they could print 400 tons of money, and it still doesn't cause much inflation, as Japan can attest to. So a direct opposite problem as it was in 1980. But again, there was hassles around the turn of power. 1987, 1988, we have a turn of power. Big problem in 87. In 1992, we had a change of power. We also had Desert Storm. In 2000, we had a big change of power. We also had the dot-com bust, and we had 9/11. In 2008, we all know we had a big problem and a big bust right as the guy was leaving. So what am I saying here? I don't know, but it seems to me that you got to have a little bit of concern about the changing of the guard in the next 24 months. Why? Because what do we have here? We have a huge move. Is it all organic? I don't know. Interest rates being kept at zero artificially doesn't sound organic. And again, only time will tell what happens, but learning how to hedge and keeping things on a short leash might not be the best viewpoint for the next 24 months. Hedging and keeping things on a short leash. That would be my prejudice. Okay, so there you go on the S&P, and there's a little bit of information on that. Let me see if I have any other little comments here on the S&P. But Europe, Europe is selling off a bit because Greece might be having some early elections, and the left-wing party might be taking over, which could derail the recovery, which means the austerity programs could go out the window, and that would be a problem. Chinese stocks rebounded a bit after selling off. Japan's are selling off a little bit today. I'm sure Asia is going to probably get whacked hard if they follow suit with what just happened here today in the U.S. Let's see, anything else here? Not really. Okay, yeah, one of the things, these oil shares, hey, lower oil, gas prices, save at the pump, 10 bucks, 15 bucks on your fill-up. Yeah, that's great. What's not so great is 9% of the S&P has to do with the energy stocks, and 1/3 of capital spending comes from these companies. So take a wild guess how much capital spending there'll be in energy companies that lost half or 2/3 of their value. Probably not a lot of capital spendings. So, nothing is ever only one thing. And so, one of the reasons we might be getting freaked out a little bit on the prices and getting a sell-off is people are starting to do the math. 1/3 of capital spending in a sector that's getting whacked, probably not going to do the capital spending, could be a problem 6 months down the road. A lot of people say that this is a discounting market looking down the road 6 months, and maybe they don't like the view right now once they start doing the math. They start doing the math on the unemployment report, and maybe all the people that are not getting permanent jobs and all the temporary workers that aren't getting paid that much anyway, whose jobs will probably go away after the holidays, maybe that's not the unemployment report, that's powerful. Next week we have a Fed meeting, and so it'll be interesting to see how the Fed takes this thing in. Okay, let's go to the next graph here, and it's on the, let's see here, hold on. U.S. dollar. Okay, the U.S. dollar is a big story because it has been going up. And what do we mean by up? Well, it's up near 89 now, and you can see it used to be at 72 not all that long ago. And so that's a 17-point move on something that was trading at 72. It's a 24% move almost in the U.S. dollar in fairly short time, which means that if you're in the yen or the euro or the Canadian or the Aussie dollar or anywhere else like that, you could have bought treasuries possibly and got rid of your currency, bought U.S. dollars through buying treasuries, and even though you didn't get any yield to speak of, you picked up a heck of a nice little jump in your currency, in the currency swap. And what do I mean by that? What I mean by that, if you look at things like the Aussie dollar, that has dropped about 7.5% recently. That dropped even more like 10%. And Canadian dropped, and they've accelerated a little bit because the price of oil going down and the commodities having trouble are hurtful to the commodity-based countries like Australia and Canada. And even the euro has gone from a high in the last 6 months of 137 down to 122 area at one point. Now it's bounced back up 124 and change, but that's down 11% as well. So a lot of people may have, foreigners, been buying these UST bills, and what could maybe be problematic is if this US dollar were to fade off of this 90 area, that people might repatriate their money at those big discounted exchange rates, which would mean dumping treasuries and buying into their original currency. And if that in fact happens, it could be very disruptive to the credit markets, so I'd keep an eye on that. Conversely, if we break above 90, and if you were looking at a 25-year chart, there's nothing but real estate above 90. In other words, there's a lot of white area. And if it was going to do some kind of a crazy advance towards 110, 120, 130 because people panic into the dollar, then of course that could even be more positive for buying of the treasuries with the foreigner money coming in. So U.S. dollar definitely on a run, definitely viewed as a safe haven. I would call it the one-eyed man in the valley of the blind. I think that might be a reasonable statement. But it is being viewed, despite all the debt that's been created, despite all the other things that are going on, it's definitely been viewed as the currency of choice in the last 6 months. Okay, I'm going to go over here now to another graph, and that's going to be on the Treasury, U.S. Treasury. And what's going on here is next week we got a Fed meeting on December 16th. What are they supposed to talk about? They're supposed to talk about their language on when interest rates may change, and their speculation that the language is going to be a little bit more that they're going to change. I mean, I don't know, to be honest, in my view, my opinions vary, but, keeping rates at this low for this long, maybe it may have been very good to push stock prices to those prices you saw, but it might also have been creating a little bit of a bubble. And, maybe we would have been able to get along very nicely with less of an advance in stocks and maybe a 1 or 2% interest rate in the bank than what might happen, which is some very big volatility as soon as they try to do something, because maybe they're a little late to the party on it. Only time will tell. But December 16th, they're going to tell you what they're thinking, and that'll probably have some significant effect on the market, and that's happening next week. OPEC is cutting their estimates on how much they're going to need to produce. I don't know if that is because of the tremendous oversupply or if they're anticipating a recessionary environment of some type. I don't know that, but we don't know that. But obviously, there's a lot of speculation on both sides about what that's all about. Other things on the interest rate market here, obviously the Fed did leave the monthly donations that they were doing in October. So November and here in December is the first 2 months. But probably the people buying the treasuries now instead of the Fed are these foreigners, and maybe if they drop the stock market, the foreigners might be replaced by domestic buying if people dump into treasuries just to get the heck out of stocks that are dropping. At any rate, the yields, as you can see, are having a heck of a time trying to go anywhere. The 10-year note today is paying 218 ballpark. 30-year bond is trading 284 ballpark. They had spike lows in October of 188 and 267. But look at the difference in yield. You loan the government money for 10 years, you get 218. You loan the money for 30 years, you only get 284. That's 3 times the risk for a very small differential in yield. So that is an example of the flattening of the yield curve, which, obviously might be reflecting a deflationary view looking forward. Certainly it's not showing an inflationary view, I wouldn't think, but I'm not an expert on the yields, but I'm just reading what I read. Again, those are what interest rate markets are doing, and there are call and put options available on all different markets, including stocks, bonds, commodities, etc. So, once you understand how the different tactics work, then of course you might look toward applying the strategies that you understand the use and the risk of, to an appropriate amount of your risk capital, and again, see how puts and calls could be applied to other markets you might have an opinion on. Next one I'm going to show you here is the price of gold, and the price of gold has been having a pretty tough run. This is a longer-term graph, right? Goes back a long way. And so basically we're talking about, when it was down at a much, well, actually this is the GLD. This isn't actually the price of gold. So GLD, as it's coming out in 05, 06, way down there in 50, 60 land, then it runs all the way up to 180. That corresponds to the price of about 1,900 gold, ballpark figure. And then once it dropped under 150, say $1,500 on gold, it's been pretty much on the defensive for the last couple of years. It did get a situation, again, order imbalances. When a market goes from 170, 180, whatever, all the way down to like 100 here, you're going to have a significant amount of selling in there and shorting. Well, if people that are short and there's heavy position short and people want to start buying them back to cover, you can get some periods of time where the order imbalances cause some pretty quick spikes, and I think that's what we've seen recently. I would imagine that there's some pretty significant resistance between 1250 and 1300 on the gold, or that would be 130 or so on the GLD. And if you were to be able to get above 130, then one technically might make the argument that it could go up towards 150, which is where it broke from and should be, if it technically works that way, some type of resistance at 150. But there's a chart where a move above 130 might indicate a move towards 150, technically. A move under 110 might take you more towards the 80-90 area, and so a move under 110 could give you another shoe to drop. So that's why right now we've had a kick back up, but I don't know if it's time to take the party hats out just yet with all that overhead resistance staring you right in the face and a very short period of time since it hit its low. Again, a lot of things need time and price in order to give you some good evidence, and there's neither much time nor much price to really hang your hat on here with this $100 move from the low to the high recently that it's just had. Again, historically, gold's like a weaker dollar. There is no weaker dollar. Gold likes inflation. According to what people say, there's deflation. Gold likes to have a lot of instability. I guess there's some of that going on. But clearly, you know, if somebody would have said interest rates are going to be at 0 and inflation is going to be anything, generally the price of gold enjoys that, as it did when there was that housing run-up going into 2010, and then, of course, you know, the drop afterwards, and then the other inflationary forces during that advance that we saw in the Bush administration. But again, the chart speaks for itself. Very big run-up, a sideways action, distribution, and then boom, down to the downside. And although we've had a pop back up, you know, again, the resistance speaks for itself right there. But again, you know, you got to follow the numbers on these things. Nobody knows exactly where things are going, so you try to follow the numbers and let the market tell you and dictate your activities rather than you dictate it to them. Okay, I am going to go over now something that is clearly in the news, and that is the price of oil. Again, look at the price of oil in 2009. Boom. If somebody told you at 150 we're going to be at 33 within a year, obviously you'd think they're crazy. That just gives you an example that when things turn, they can turn big and they can turn fast. So there you go, right there, 150 down to about $33. Since then, we ran up towards 110, came back to 90. Came back to 80. Back up to 110, back down to 80. So obviously we were in a trading range, even if we didn't know it, for about 4 years between 80 and 110. There you go. Now what has happened here is we busted through the bottom, and we busted through it pretty darn good here. So you can understand why we've got a big seller, no buyer environment right now, and this order imbalance has caused a big drop. Now the moving averages that I keep an eye on oil come in above 90. So if the moving averages are at 90 and you're down at 60, that is by definition an oversold condition. That doesn't mean it has to pop up, but it certainly means that if it did start popping up, it wouldn't shock me, because again, you know, there's a lot of liquidation to get from 110 to 60. That's a lot of liquidation. And so at some point when that market stops making new lows, a pop back up towards 80, which is where those former lows were that it busted, might be the new range. So I don't know if it's going to be 60-80 or 50-80, but my suspicions is that's the next move in oil, some type of a trading range as they digest all of these drops, and obviously they get the carnage out of the market, and the people who are overextended get them out, and the people who are overextended get them absorbed by other companies, just like they did with the banks. Right? So when you get these kind of drops, you're going to have fallout. Fallout has to be taken off the field before, you know, much of anything on the upside may be able to occur. But, you know, if it does turn, just like it did in 09, you know, obviously it can turn and go on some runs. But, you know, the idea it's going to go from the low of 33 back to 150 in a short run is not very realistic. So right now, again, what I'd be looking at if I was in oil, when it stops making new weekly and monthly lows, that would be a good sign. And then what would I anticipate? I would anticipate a possible range between whatever the low is and about 80. And that is basically how I would see that occurring here. Let's see if I have anything else for you. Okay. All right, let's go back to the stock market so you can keep an eye on it right there. And, you know, like I say, we are going to have a webinar happening tomorrow that I would like to invite everyone to attend. The webinar will be at 4 p.m. Pacific, 6 p.m. Central, and 7 p.m. Eastern Time. Those of you guys in Denver and New Mexico, Mountain Time is 5 p.m. So that's going to be tomorrow, Thursday, and we'll have a lot more to talk about and a lot of different stuff to talk about. So I would like to invite you guys to check that out. It is free of charge, and so I'll give the website out in a little bit on how to take advantage of that and exactly what you get when you do take advantage of it. Looking through my notes here, I'm trying to see if there's any other news things that are going on here. And let's just give you a couple of let's see how some of the higher flying stocks have been doing. Like Amazon.com has a 52-week high of 408. It's now trading 305. Apple obviously was a pretty big mover. It is at 111. Pre-split, it was as low as 384, I think, and then it was as high as 703. So when we hit 120 almost recently, that is a pre-split price of 840. That's 20% higher than the all-time high before they split. So there is good news on the iPhone, I'm sure, but how much has been discounted if you go 20% higher than the all-time high? And another thing I always keep an eye on with Apple is they did have a $700 billion market cap. It looks like now it's at around 659 as of yesterday, maybe. At any rate, that's a lot of money. And then, of course, they are focused pretty much on the one product, although they have obviously other products. But certainly their iPhone products are a big part of it. And of course, their paying app that they're trying to get started is a big factor as well. So if a lot of people bought in that this the pay app is going to be a big deal, and it doesn't turn out to be a big deal, that could be some vulnerability. Conversely, if it turns out to be a rainmaker, it could also propel the stock higher as well. But right now, the stock is on the defensive a little bit, down about 8% or so off the high. Some of the other ones that I sometimes look at to see how they continue. LinkedIn used to be 238, now it's at 215. It's hanging in there. Tesla had some news. Give you a little bit of a rundown on that one. And Tesla was as high as 291. It's trading 209. I had thought I had read they had some good news report, but today it was down 3.25%, down $7 at 209. But that one obviously can go back and forth pretty good, because just since this year alone, it's been as low as 136, as high as 291, and now it's at 209. So apparently when you buy into Tesla, it comes with a seatbelt, because you're going to need a seatbelt if the volatility keeps going back and forth like that. Other markets, let's see, did the oils get slammed here again? You've got ExxonMobil down 3%. You've got Halliburton. Used to be as high this year, 52-week high of 74. It's now trading at 38. Ouch. That's a big company too. Their market cap now, even with the drop, is 33 billion. So obviously when it was higher, it was even more. And so bottom line there is, it gives you a little illustration that there's real money being lost with this drop in oil, and just because we save a little bit each week on our fill-up is not going to offset the fact that there's probably other peripheral effects with, again, one-third sounds like a lot, of capital spending comes from that industry, and 9% of the S&P itself is of that industry. So bottom line is let's not rejoice too much with this drop of oil, because there's other people that are getting whacked on it pretty hard. With regards to the webinar that's coming up tomorrow, there is a website I'd like to give to you, optionprofessor.com, O-P-T-I-O-N, professor, P-R-O-F-E-S-S-O-R.com. And some of the different things that are available at the meeting is, we give you all the different ideas on how the uses and options work. Some people ask questions about option writing on some of the stock indexes, and also how the E-mini S&P can be traded in concert with the big S&P, and what are the different uses, risks, and advantages and disadvantages of trading both indexes at the same time. So some of you guys who do a lot of trading might find that interesting because I've been in this thing a long time, and I am a recent acquaintance of using the S&P and the E-mini in connection with each other. So, okay. And so anyway, the website to go to is www.optionprofessor.com. OPTIONPROFESSOR.com. And when you go to that website, there'll be two things to click on. One is called registration for the webinar, and the other is called attending the webinar. So today, when you go to the website and click, you fill out your information and you register. So you click the button that says registration for webinar, and then they ask you questions, and you fill it in, and boom, you'll get the passcode, because you need a passcode to get in. And by registering, you get the passcode. And then basically you come back tomorrow, Thursday, 4 p.m. Pacific time, 5 p.m. Mountain, 6 p.m. Central, and 7 p.m. Eastern. Okay, that's when the event occurs. And then you go back to the same website, optionprofessor.com, but this time you click Webinar Login. And then you take that passcode that you received today by signing up, and you put it in there, and then you attend and take advantage of the free meeting. Now, one other benefit to the free meeting is that there are 7 option learning DVDs. And they, in my opinion, add real value to you as your education on using and understanding the uses and risks of options are going to happen. And on the internet, the DVDs go for $995, but the people who come to the meeting are rewarded by getting a discount of $700 on the DVDs. And that brings the price down to just $295, which by any measure is a giveaway. Why? Because I've been doing this 30 years or better, and I've been educated in this area, and I'm knowledgeable in this area, and you are going to learn something that you don't know now on the DVDs. That's number one. Number two is that there are 5.5 hours of material broken down by strategy so that you can identify what strategies you might be interested in, and you have a permanent reference guide for $295 so that you could better understand the use and the risk of each tactic. Finally, if there's a question on a tactic that you don't understand and you want to ask a question, there is a toll-free number you can call where I might be able to help you better understand the use and the risk of strategy. So there's 3 great benefits there, and again, $295 is peanuts for the value you're getting, and again, compared to the cost of some of these things running around town, it's a giveaway price for sure. So there's 2 advantages. Obviously, you learn more by going to the seminar, and 2, you can save a whole bucket of money and get some good information as far as your understanding of the options, and it's a permanent reference guide for you or anyone else to take a look at to understand this stuff better. So I think that's a great deal, and obviously, I think you will too if you pursue that. Again, for the Option Professor, I do provide the content because I have been doing the seminars for 30 years. Obviously, I have an ability to explain in a balanced presentation, how these strategies work and don't work, etc. Again, whether any strategy is right for you is not my call because you, your broker, your clearing firm are going to figure that out. My job on the DVD is to make sure you understand the tactics so that whatever tactics you want to pursue, you understand, a larger menu of potential strategies to consider looking at a circumstance, meaning the market's rising. Okay. In other words, I'll give you another one that I've seen seems to be misunderstood. These iron condors, where you trade both sides of the market in a spread form. Okay. Obviously, if the market's dead as a pancake, which it was for many, many months, obviously that strategy could work like any strategy who wants little volatility. But, because you're buying an option against one that you're selling, I mean, in essence, you're selling an option you think is a ridiculous price, and then you're buying a higher one away from it, which, if it's a call, a higher one away from it, that's even a more ridiculous price. So that's a little bit of a negative because you're having to buy another one. But it does give you limited risk unless one side gets executed and the other side doesn't. And also, like I say, though, it does make you have to go a little closer to the money to make the credit make sense. Well, the problem with going closer to the money, you do not want to get whacked on your strike price, and the closer you get to where the market's currently trading, obviously your odds are going to be increasing just using mathematics. The other thing is regarding the volatility, and let's one thing real quick for you guys who haven't done a lot of options. When I say out of the money, if the S&P is trading at 2025 and you're looking at an S&P that has a strike price of 2050 or 2100 or 2200, that's called out of the money because the striking price is higher than where the current market is. Conversely, on the put side, if you're at 2025 on the S&P and your strike is at 1975 or 1900 or 1850 or 1750 or whatever, those are called out of the money options because the striking price on the put is below where the current market is trading. And the further away you go, 200, 300 points out of the money, they're called deep out of the money options because the striking price is substantially away from where the current market is. Now again, because people are using put options on the S&P as an insurance on a bigger portfolio, you will find that the deep out of the money puts will be going for a far greater premium than the calls because there is a demand for put hedges or put insurance way out of the money. That is a situation that creates an event for the seller to look at different strike prices that are well outside the range that the markets have been trading at. And as long as the market stays within the parameters, which is a big if, there is interest from the sell side sometimes for the deeper out-of-the-money options. So again, no strategy is right for everybody. You should investigate very, very thoroughly each and every strategy you take a look at. And clearly, as I've said in the beginning, no option strategy is right for everybody. So do investigate before you invest. I think that's very important. Again, today, not a very good day for the bulls, very good day for the bears. Tomorrow, Thursday, some people believe that Thursday sometimes can see some type of price action that can be a reversal to other days, because maybe as we get closer to the end of the week, if everyone's been making money on the sell side, you can get a short covering rally. Conversely, if the market has been rising or it has been failing to make new highs on something, Thursday sometimes can be a day where people take profits. So I don't know if there's any science to that. I'm just observing, and I'm just saying that sometimes my opinion is Thursday is a pretty important day for the markets, because if all this selling cannot get any kind of a rally Thursday, or early Friday at least, that means people are pretty confident with their sell positions going into the weekends, and that would not be the greatest sign that we are going to stabilize down here. So keep an eye on the next 2 days, Thursday and Friday, and see if we can generate some type of a short covering rally or some kind of a stabilization. Because if we can't, that might not be the greatest sign in the world. Again, and that's not an exact science either. Be clear as a bell on that. It's just something that I've observed over the years, that sometimes Tuesdays and Thursdays can be days where things are reversing a bit. In fact, at the end of Tuesday, if you notice, yesterday, they did do a little bit of a short covering rally at the end of the day, but today it was met by more selling. We'll have to see what tomorrow brings. It'll be interesting to see on that as well. I would like to be able to view and look at some of your questions, and hopefully we'll be able to get to those as we speak to you a little bit down the road. I did want to just reiterate again that you can go to the webinar tomorrow. It will be happening at Thursday tomorrow at, again, 4 p.m. Pacific and 6 Central and 7 p.m. for the East Coast guys. And again, the website to go to today to get registered is optionprofessor.com, O-P-T-I-O-N, professor.com. Click on the word registration, put your information in, and you'll get the participation code. And then, of course, the participation code will give you access tomorrow when you go back to the website and then click on the word webinar login. I don't know if Dan is out there or not, but if Dan is out there in Cyberland.
I am here.
I was just going to hand it back over to you if it's okay. Is that going to work with your timing? Or?
Yeah, no, this is perfect. Jim, thank you very much. That was a lot you packed in to this last hour.
Yeah, well, like I say, yeah, there was a lot to cover. And again, as I talk to the people individually or at the webinar tomorrow, maybe I could get into greater detail on some of their specific questions.
Yeah, I don't see any immediate questions, but I'm sure that if people take advantage of that free webinar, and certainly they should, that come with your questions. And Jim, obviously you've shown today that you've got a very good handle on the markets and a very good understanding of the history and the global economics of it. So I don't foresee there are too many questions you won't be able to answer. So. Again, I would encourage everyone to go to www.optionprofessor.com, and there is a button on there, as Jim had mentioned, or a link saying free option learning webinar registration. It's right near the top of the page. So please sign up for that, and definitely avail yourself of a lot more of this great training. So. Jim, thank you again.
Okay. Thank you very much, Dan. And again, I wanted to thank everyone for being here today. Look forward to seeing you at the webinar tomorrow. And until we talk again, of course, good luck and good trading.